HSBC's China Manufacturing Survey showed rising optimism. The Purchasing Managers Index, a gauge of economic activity, rose to a 13-month high of 50.4 for November. Readings above 50 mean growth. For more on the Chinese economy, Raymond Yeung, senior economist at ANZ, joins us. Raymond, welcome to the show. I want to ask you, the Chinese Manufacturing Sentiment Index, does this mean, is this the turnaround that you've been looking for?
I think it has been largely expected by the market with the improvement of the general economic condition in China. So the PMI figures now rising above 50 has been largely factored and priced in by the market. And we've seen that the inventory level of China has been dropping, and then the commodity prices level has been rising. So that's also, indicates a general improvement of economic activities, and all these activities have been picking up over the past few weeks, especially ahead of the 18th Party Congress that was held last week.
We had a great debate during the year versus hard landing versus soft landing. Is that debate finally over yet, or is that still on the table?
No, I don't think that any analyst will continue to call China will be heading to a hard landing scenario. But the question is really when we're going to see a full-fledged recovery of the Chinese economy. The government has been launching trillions of fiscal program, including investment, particularly in railway ministry, and also some of the local investment project will be kicking off, especially notably the public housing projects. All this will be accelerating over the next few months because we only have 3 years left to achieve the target of the 12th five-year plan.
Speaking of targets, what's the biggest risk right now in the economy that could potentially affect those targets?
I think inflation is always a risk for China. If we think that the economy is now bottoming out, but at the same time, major central banks, global, including Japanese central banks, U.S. Fed, and they're going to print money and continue to have this quantitative easing. Hot money flow is continue to be biggest risk for all the emerging economy, including China. Although China has a tight capital control, but domestically, if we see that external, we face this hot money issue, but internally, we are having a economics growth going to be picking up, then inflation will always be the biggest risk because a strong growth of China plus hot money flow globally means a higher commodity price on the global level.
All right, Raymond Yeung from ANZ, thank you very much for joining us on the show with your analysis of the economy. That's almost it for BizAsia America.